The reason I've got the bulk of my portfolio in value-add multifamily private placements is, to me, it's one of the best combinations of benefits that you can have as an investor.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey guys, welcome to another episode on Wealth Strategy Secrets. Today we are joined by Travis Watts. Travis is a full-time investor, passive income advocate, and public speaker. As the Director of Investor Education at Ashcroft Capital, he's on a mission to empower investors who want a hands-off approach to real estate investing. Recognized for his outstanding contributions, Travis received the prestigious Linda's Industry Impact Award in 2022. Travis, welcome to the show.
Hey, Dave. Thanks so much for having me. Thrilled to be here.
Yeah, no, it's really awesome to connect, Travis. We were having such a good conversation, you, me, and Jeremy Roll at the Charlotte multifamily conference, and really thought, we've got to bottle this and take this out to the community because there were so many, pearls of wisdom in there and everything that we could unpack. So for folks who don't know you, why don't we start, the discussion off with a little bit about, your background and your journey, and then, that we can pick it off from there.
Sure. Happy to share. So first thing I would say is, I didn't come from a family of wealth or real estate or investing. My parents had split when I was 5 years old, got a divorce. I was raised by each of them independently, and I learned a lot about frugality. Anytime we brought up finance or the term, we were talking about saving money. So grateful for that humble upbringing. But at a certain point from doing my own self-education, I realized that your potential only goes so far if you're just going to pinch pennies your whole life. The real reward comes in learning how to multiply your money and learning how to invest. So tried a multitude of small business ideas early on that didn't work out for one reason or another. And I landed on real estate when I was 20 years old, bought a single family home. This was in 2009. And, about 40% discount to previous pricing. And I rented it out. First I lived in it a little bit. I furnished it, I updated it. And then I made that my very first rental. And that was the first thing that really started to get the wheels turning. I thought, okay, I'm making whatever I was making, $600 a month cash flow. I thought, how do I amplify this? And I knew I needed to make more money, or at least I thought I needed to make more money in order to become a serious investor. So I went seeking jobs that just paid well, that didn't require a lot of background experience or, a specific college degree. So I ended up in the oil and gas industry, and I ended up working 14-hour days, 98-hour work weeks, months away at a time, working overseas in the Middle East. It was a crazy time in my life, but that's where the frugality really paid off. And I was saving tons of money, paying very little in overhead for my lifestyle. And I was dumping all of that into real estate, specifically single family, for about 6.5 years. I did flips, vacation rentals, buy and hold rentals. I had roommates back home that would effectively pay my mortgage when I wasn't there. And it was an interesting time. I don't necessarily recommend people take that specific approach, but that was my 10 years of darkness, if you will, of just kind of grinding it out and trying to get ahead. And in 2015, I started transitioning my portfolio into multifamily private placements, or syndications in layman's terms, and other passive income generating assets as well. And so it allowed me to basically get my time back, something I refer to as time freedom, so that I could go pursue still active work, but work that I truly enjoy and that I benefit from, and being in a position to really help people. And that's really what I wanted to do from the get-go, but I had to put in those dark years.
Yeah, for sure. Did you have any particular pivotal moments where you either learned something, or you had a conversation, or you read a book that really just said, okay, now I've got to take action on this?
Yeah. So I would say my biggest personal regret in my investing journey was starting out thinking I'm a do-it-yourselfer because my parents were, and that's how I was raised. Why would I pay somebody $30 to mow my lawn if I can do it myself? Why pay a painter when I can paint? So I went into real estate with that kind of mindset. Even like it was very naive to think, I don't need a team and I don't need to be an expert and I'll figure this stuff out. I can do it. And I realized after 6.5 years that real estate really is a team sport, and it can be extremely beneficial to partner with people that are more of an expert in one area or another compared to you. So what changed is I started reading books more. I started listening to podcasts more. I started joining real estate meetup groups in person. This was out in Colorado. And I ran into a couple gentlemen. They run a very big investment club in Colorado. And they had become financially independent probably 30 plus years prior to me meeting them. And I was kind of picking their brain about investments. And I said, what are you guys primarily investing in? Is there one thing that you really focus on? And they said, yeah, well, as a general, bucket, it's private equity. And more specifically, it's multifamily apartment communities. And we're limited partners in other people's deals. And I had never heard of that before in my entire life. And that was a huge pivotal moment because I was starting to reach a point where I thought, if I sell all these properties that I currently am operating and I pay all the tax and broker commissions and I just look at what I might have in cash and I went to invest that passively, it started to become meaningful passive income, right? So in the example of someone getting started, they got $10,000 to go invest. They go look at a passive income deal that yields them 8% a year. It's like $66 a month, right? It's not very meaningful. What are you going to do with $66 a month? Fill up your gas tank once on your car. So it's not very motivating to be in that particular position. But if we take the same example with someone who has $1 million to go invest at 8%, now you're talking about $80,000 a year in additional supplemental income. That starts to be a game changer for a lot of people. And I was, approaching that level in my personal journey. And I surprisingly ended up making more as a passive investor than I even did as an active investor. And so that was a huge pivotal moment to realize the power of passive income and what that can do for you.
Yeah, no, really great points there. And I think so many people struggle with, actually taking action. You might hear a good podcast, you read a good book or something, and then you're trying to overlay that into your own situation, and you might be W-2, you've got a career, you've got a family, you've got all of these intricacies involved. But it's really, just having, I think, that moment, that epiphany where you can take action. And then as you take action, you can start to bear the fruits of your success, right? And then that's going to open up, new doors you didn't even think were possible.
Yep, 100%. That's right.
So Travis, I love your, passive investor journey, right? And I think there's so many different elements of this to really unpack. But let's really talk a little bit about the psychology, right, of passive income first, right? So it's a term just like financial independence, right? Financially free, right? What does that actually mean to you? What does having your income exceed your expenses, mean to you? Because if your, if your expenses are only $4,000 a month, maybe you're actually still living in that frugality world, right?
Mm-hmm.
But you've technically achieved that financial freedom. So tell us a little bit about, what did that actually mean to you to, achieve financial freedom, and how has that evolved for you?
For me, I was in a job, which was the oil and gas gig, that I really didn't enjoy. I knew this wasn't going to be long term. I knew I couldn't, physically withstand that type of work for, 30, 40 years and make it a career. So my goal was to get out of that job. And I think, what's cool about passive income is you can start immediately. You can start with low dollar amounts. You can start with that example I gave earlier of $10,000, 8% a year, 66 a month. That's just step one. And you can build upon that. And passive income creates a backstop for you. So what's cool is as you kind of climb the ladders of wealth, and let me identify that for your listeners, what I mean by that. So I think of the wealth pyramid kind of like an upside down triangle. So at the bottom is self-sufficiency. This is where you're basically your paycheck to paycheck. You have an active source of income, but at least you can pay your own bills without having to be supplemented from some other source. Then you move up to stability. And this is what a lot of the gurus in the finance space are preaching, whether it's a Susie Orman, a Dave Ramsey, these types of people. So stability is like, pay off your debt and cut up the credit cards and have an emergency fund. And, only at that point can you start to think about investing. Right above that is flexibility. And flexibility is where you have some investments, you have some passive income rolling in, maybe not enough to live on, but maybe a few thousand per month, And so the flexibility is, what if I get fired or lose my job? Well, at least I have this other source of income over here. What if I want to try a new career and make a pivot? Well, it's not so scary knowing I have a financial backstop over here. Maybe you want to take some time off and travel. We were just talking about traveling to Italy, something that both of us value. Financial independence is right above flexibility. And that's what I really teach people how to create. So financial independence to me is the ability to solely live off of your investments, whether they're cash flow, passive income investments, or whether they're just, owning some stocks and making sales to live on, however you want to approach it. It's just that you don't need active income anymore. And the highest tier is financial abundance. And these are the people, of course, in all the headlines. These are your Mark Zuckerbergs and your Jeff Bezos and your Bill Gates. And they have so much money that they could not even live on it if they tried. I mean, you can't spend that much money reasonably. So they're going to end up donating, most of them, the majority of their wealth back to society. So that's kind of what I mean by working up the wealth levels. So I think everyone can reach, in my opinion, most people can reach flexibility to financial independence. It's just going to be about how long does it take you. So to answer your question about mindset, I would ask your listeners to think about this. How many of, did your parents teach you about passive income investing? Did the school system teach you about passive income? Did Wall Street teach you about passive income? I mean, the answer is usually no to all of those. So it's a journey of self-education. And yes, it takes willpower, drive, motivation, repetition, consistency. And a lot of people don't talk about those factors, but they're extremely important. And I've seen this unfold over the years. You go to a conference, there's a hard sales pitch on the stage. People buy these $10,000 programs, and statistically, the majority never even use the program, right? They attempt it, and then they change their mind and go another direction. So you got to get clear on your why. A lot of people talk about that, kind of cheesy, but kind of true. What are you really trying to do? Is it really about money? Because I hear people all the time talk about their money goals. I want $10,000 a month passive income. I want to be a millionaire. I want this, that, and the other. But what do you really want? So think about if you had $1 million cash in your bank account, or you had $10,000 a month passive income right now every month, what would you do? Why do you need 10? Maybe you only need 5. Maybe you need 20, and is 1 million really the goal? Or is it just, generational wealth that you're looking to pass down? So start by, identifying your goals and objectives, and then kind of reverse engineer into them. What types of investments can help you reach those goals? What kinds of companies or people are offering those types of opportunities? And so you kind of start to learn the game backwards. At least that's what I did.
Yeah. And why do you think there is such a challenge in this country in terms of basically financial education, understanding passive income, understanding alternative investments, understanding, investing in real estate? Why do you think?
I think it all roots back to, why was the education system even created in the first place? It was to have a formalized way to train people to become employees and work for companies. So why would it be in anyone's best interest as a company owner to empower people to have that kind of knowledge and to go create competition for them, right? Or to quit the job because now they're financially free through their own investments. So I think it kind of rooted there. And as we've moved forward into the more modern era, marketing has really taken a hold of people, especially in America, in terms of you need all this crap, right? You need the Gucci bag. You need that BMW. You need that McMansion house. You need these things, but do you need them, right? Or are you just trying to impress other people or feel some kind of elevated level of status? And so again, it takes a little soul searching, but you got to figure out what really brings you, satisfaction and happiness, and I'm the type of person that I did this with my wife. We've done it numerous times over the years. We sit down independent of one another. We write down the 10 things that bring the most happiness and fulfillment to us. And I would say 60% of my list requires almost no money, right? It's like walking in the park with our son. It's going on a bike ride at sunset, right? It's going to the beach, which happens to be 45 minutes from our house, like very minimal stuff. And so when you start to identify that, I think you can kind of lessen the consumerism side of it, which is what's caused a lot of people to go to paycheck living. It's very interesting to look at excess cash that Americans have leading up to the pandemic. Most people being paycheck to paycheck. All of a sudden, stimulus checks come out and the percentages fly up. Everyone's got all this money, right? They're $1,400 or whatever it was. And then 2 years after, everyone's back to paycheck again because people spend their money because we live in a capitalist consumerism society. So I would just question that individually and just say, do I really need these things, or are they just wants that aren't really necessary? And it's worth a internal dialogue with yourself. Or
yeah, no, I think it's really fascinating, right? Because, I was raised in a middle-class family as well. And, there's starving children in Africa all the time. It puts you basically into a scarcity mindset. With everything you do. So like you say, you're trying to do it yourself, because if you can do it, if you've got the energy, the will, then, you can do it. But what's interesting, right, is as you start to scale and look at things with an abundance type mindset, right, you can realize, as you pointed out, that you start to work with a professional team, and now you're getting leverage by the team. Right. And then you're also now focusing your time, instead of doing, say, active management of assets or whatever, maybe it's a side hustle or whatever you're doing. But now you can really focus on what you're actually good at or your unique ability. And then, you can really exponentially grow. You can be more fulfilled. Right. Because I think what most people are looking for in life is actually it's not only freedom of money, but it's freedom of time, it's freedom of purpose, to be able to wake up every day and be fascinated and motivated about the work that you do. It's also freedom of relationships. Like, who do you want to spend your time with? Right? You're a product of the 5 people that you spend your time with. So are those people, exciting you, or are they taking you back, But I think I think this really shouldn't be underestimated, is that deep thinking around, your why, as you point out, which is such a great, exercise to do with your wife. Another way people could look at it is, instead of creating a bucket list, create your top 100 list of things that you either want to be, do, or have. Yeah. Right. So then it takes a little of the consumerism out of it. And then that's what gives you the drive to move forward.
I love that. That's a great point. And, just to add real quick onto that, it's like, I use the wealth pyramid example, but it's like Maslow's hierarchy of needs. At the very bottom, we need food and shelter. And then you start to move up after that, and you're looking for safety, and you move above that, and it's relationships. And then, at the very top, it's self-actualization, which is what you're talking about. Who do you want to be? What do you want to do with your life? What's your why? What's your mission? And, who do you want to hang around with? So great points.
Yeah, no, and I think that's why it deserves some thought, right? Because let's say you do reach that passive income goal, and this is why it can also be a trap, right? It can be a double-edged sword. So if I only had, whatever that amount is, 5,000 a month, 10,000 a month in passive income, exactly to your point, what is that going to enable me to do, right? Because, you don't want to have abundant complacency, where you say, and there are a lot of people in that FIRE community that,
Mm-hmm.
you know, reach that passive income number. And then they're like, hey, you know, I'm just going to kind of sit on a beach and, you know, I don't need to work anymore. I don't need to do anything. Right. But
Yeah.
that's not necessarily fulfilling. It's
Right.
actually rewiring, you know, those things that you want to do. So Travis, let's kind of bridge that also into this dichotomy really of active versus passive investing, because I think this is also something people really, you know, think about a lot. They say, and from the first times that, you know, I even got into real estate as well, I thought, okay, I'm going to do active investing. I didn't even know what passive investing was either. This is like back in 2000, Rich Dad Poor Dad just came out.
Yeah.
So I'm driving around, you know, with my kids at night, looking at properties and, you know, how is this really going to scale? And it's that component of time, right? You know, how do you want to spend your time? But how do you really view that? And how do you talk to folks about that? Because you've clearly lived both sides of the coin.
Yeah, pros and cons. I'm not here to bash active investing. It was successful for me. I did it for 6.5 years, as I talked about. I tried a lot of different things in there. I would say that if that's truly what you want to do, first of all, maybe try it out. Maybe get one rental property or try to do one flip and just see how it goes. It was a lot of self-reflection for me. So I started realizing that I'm really not the best at this. I'm not finding the best deals. I'm not finding the good off-market deals. I don't have the best connections to contractors. I'm not getting the best pricing on things. And so as more institutions started moving into the space and the market started to lift off again, I was getting squeezed out. And that was kind of that realization that, maybe this isn't really your thing. And the other thing I was naive about is to think that I could really scale that business, meaning, let's say I bought, one property a year for the next 30 years and then I retire. Well, let me tell you, having 30 single family homes that you manage is more than a full-time job. And even if you have a property management company, it's a full-time job. And there's a lot you have to do that's still active. You got to still find the deals, underwrite the deals, show up to closings, know the markets, be attractive to lenders, have good credit, have solid down payments. I mean, there's just a lot to it. Managing tenants is only, 10% of the equation. There's a lot more to it. So, the biggest pro, there's two big pros to going active. One, you're calling the shots. What color do I want to paint this house? How do I want to furnish? What's the business plan? What do I want to do with the rents? Do I want to refinance? Do I want to sell? Full control. That's awesome. So if you're a person that needs that or wants that, then consider that. The other thing was, in general, I had pretty high returns, going active. Now, some of that had to do with where we were in the market cycle, right? We're talking about 2010, 11, 12, 13, 14, the market's starting to recover and bounce up. A lot of my properties, I just lucked out and made a lot of money because the market went up in my area. Passive, though, is way more scalable. Whether I have one limited partnership investment or I have 300, it's not that complicated. I'm going to get probably a monthly email that says, here's how your property's doing. And I don't have to make any decisions on anything until we go to sell, So it's much easier to scale, much easier to diversify. I can be in markets I otherwise wouldn't be in because they're too far from where I live, but it's a market I really like and would like to invest in. And to your point, I really get to maximize leverage on true industry experts that live it and breathe it and are trying to build a brand and build a legacy for themselves. And I was never really at that level on a personal note, to do those same things. So, and a lot of our investors, just to be clear, are a hybrid of the two. It's like, I talk to investors all week long. It's like, yeah, I got a couple rental properties, a couple short-term rentals, whatever. And I'm just looking to diversify and try some of this, passive income stuff. So you can be a hybrid. And in fact, Joe Fairless at Ashcroft, where I work, he is too. He's obviously a GP at Ashcroft, but he's an LP in a lot of people's other deals as well. So it's just a way to maximize your time. We only have so much time and resources and energy in a given day, week, month, year. this is just a way to keep amplifying your income without having to put extra work and time into it.
Yeah, totally agree. Do you have a particular investment thesis or a wealth strategy that you're using personally?
I mean, the simple thesis for me is just invest for passive income. And it sounds simple, but if you think about it, again, back to what I was saying earlier, how many people taught you about that? You know, how many people are preaching that? How many ads or commercials and billboards do you see about passive income, right? Hardly any. And most people are investing with the mindset of buy low and sell high. You know, put $1,000 in my IRA, and when I'm 65, I'll take a peek and I hope it grows. You know, or I'm going to buy a house for 200,000. I'm going to flip it for 300,000. That's buy low, sell high. A lot more risk and unpredictability in that type of investing. Nothing wrong with it. A lot of people do it. You mentioned the FIRE community, you know, doing their index fund thing and selling off shares, whatever. But I like to just live off passive income, keep my initial investment preserved in the deal. So that's how I've always approached it. I've averaged about over time about an 8% average cash flow yield. So some deals I'm going into today might be a little bit lower. Some deals I've been in for 5 years are significantly higher. So I just try to average 8%. And then when I have a sale happen or a refinance, and all of a sudden I have extra liquidity, that's kind of just the icing on the cake, right? I can pay taxes with that money. I can pay for other things in my life with that money. I can choose to reinvest all of that into more deals and just compound the passive income. So my main focus is just on monthly cash flow. And I think if people really could see it through that lens, really experience it themselves, kind of start at that $66 a month and grow it to $666 a month and grow it to $6,666 a month, you would start to get the big picture that, you know, this is what the ultra wealthy do. And this is a very viable, long-standing strategy that people have used for decades and decades and decades.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have? And get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, I think the problem really stems with Wall Street and what was frankly told to all of us, to our parents, to our employers, to our peers, which is this whole investment thesis around a 60-40 portfolio, consisting of stocks, bonds, and mutual funds. And they talk about this accumulation theory, right, which is getting to that nest egg number at retirement. But in actuality, what is that really then converted to? It's then converted into income, right? But you've had to actually wait 35 years, right, to either, to access any of that income. So I think that's where a lot of it really stems from. And people just, aren't really aware of, passive income kind of strategies. And then also, let's just talk, more about how you create this strategy, right? Because it's a process of investing. It's not just invest in one deal or another, right? We want to be doing multiple deals a year, and it starts to snowball. Like you said. Yeah.
Happy to highlight a couple things on that. So if you think about it, I'll just kind of pull this example on a whim. But if you start with, let's say, $50,000, you're investing in something that gives you a 10% return a year in passive income. So that means in year number 2, if you're going to just continue this investing journey, you only have to put in $45,000 the next year because you had received $5,000 from the previous year in distributions, right? And every year gets a little bit easier because then you only need to put in $40,000, then $35,000, then $30,000. Now, as you zoom forward and we look at a decade or so, your investments are funding themselves in theory, right? Because now you're making $50,000 a year in passive income, and you can make an entirely new investment at that point by putting no new money into the deal. And this is obviously just compound interest example, but that's one approach, right? If you're looking to truly build up a high net worth over time and you got an active career that you're happy with and all that good stuff, that's one way to do the passive income game. I use the rule of 72 all the time. 72 or the yield that you're receiving divide by 72. So, what a 10% return takes 7 years to double your money or something like that. So I kind of look at it like that is every few years, I'm just adding new investments without having to put new capital into them, even though I do put new capital into them. The other thing go ahead.
Yeah, I was just going to say, I mean, on the rule of 72, right, with the S&P average, right, it's about 7 years before you double your money, right?
Yeah.
But, typically looking at multifamily over the past decade, you could do that in a 5-year stretch.
Yeah, and many deals have, and I'd like to actually talk about that a little bit. So the reason I've got the bulk of my portfolio in value add multifamily private placements is, to me, it's one of the best combinations of benefits that you can have as an investor. You can get monthly cash flow, you can get equity upside participation, you can get tax benefits the whole time. And so you're utilizing both the buy low and sell high philosophy, but even if it doesn't work out on that end, you still have the cash flow side of it, right? And then again, the whole time you're getting tax benefits to offset that income, or at least having long-term capital gains upon sale if you're holding longer than a year. So it's really a fantastic strategy in my opinion. So you look at other things like, I'm going to go buy some bonds for passive income. Well, no equity upside. Or I'm going to buy the S&P and hope it goes up. Well, no cash flow, very little, right? It's like pays like 1% or something a year. So This is just a great hybrid approach. And just real estate in general is, if you treat it that way. It's an intermediate to longer term play with a lot of packed benefits into it.
Yeah. And do you think that the asset class, it's still the right time for it? Clearly there's a lot of distress kind of building in the marketplace right now with people who had, poor loans, say a couple of years ago, right? When they took out floating rate debt, they've gotten, and with interest rates kind of where they are in the market changing, do you still feel like the fundamentals are strong, or, what are your thoughts on the current outlook for multifamily?
Sure. Happy to share a few things. The first thing to realize, whether we're talking about a real estate cycle or a stock market cycle, the saying goes that the bull takes the stairs and the bear jumps out the window, meaning it could take 10 years plus for a bull market to fully develop, but then a recession comes and it can collapse in 12 to 24 months and then start a recovery phase again. So I think that we are in the midst of seeing the final developments of this real estate cycle reset, meaning the Fed went the most aggressive that they've gone in U.S. history on raising rates. That directly impacts the purchase price of these properties. So we've seen cap rates reverse. We've seen pricing come way down. We're about to close on 2 deals that we're getting about a $50 million discount on relative to pricing 18 months ago. So if you can still find a cash flowing asset, and maybe you can put some fixed rate debt on it, and you're still going to be cash flowing day one, it can be a great opportunity this year, because if the Fed stays near the top, you can still execute a business plan like you did in years past when interest rates were 3% and 4% up and down. If they taper rates back down because we hit a recession or we hit the inflation goal or whatever, you might be able to refinance early, maybe sell a property for more than what you projected. So I think 2023 is now a much healthier market than 2022 and 21. I mean, even I was very skeptical in 21 as the stock market's up 30% and real estate's reaching all-time highs and stimulus money's flying everywhere. People are gambling, crypto's going crazy. I thought this is not sustainable. I'm a little nervous to see what's on the other side of this, because markets don't just go up 30% a year, and rent growth at double digits is not usual. So we're seeing a flattening, a reset, whatever you want to call it at this moment in time. And yeah, I'm still investing this year, just like I did in previous years. I may even go a little bit harder this year, but I'm very bullish on the future from here. We know the Fed can't take rates, double them again, basically, right? Or the Fed funds rate is going to be 10%. I mean, you would implode the economy and the whole world for that matter. So we're nearing the top. And like I said, you got 3 scenarios. and 2 out of 3 can be very bullish for real estate. And the only one that's not is if they keep going up and up and up with rates. But again, their other obligation, the Fed, is to help the economy in the event of recession. So they go much higher, they're going to force a recession. Then they're going to have to cut rates to bail them out. So you get back to the third scenario of cutting rates anyway. So that's just kind of my personal opinion on it. Who knows? I don't have a crystal ball, but that's how I look at it.
Yeah, exactly. And I think, one of the things that I've learned as an investor over the years is that, so much of investing is around expectation management, right? If you're forecasting a certain pro forma to return something and then it misses, what is the attitude that you actually have towards that? Is it that, the operator did not, execute according to plan? Or are there market dynamics that are outside of your control, such as the Fed, doing unprecedented, interest rates, right? That we didn't underwrite to, you didn't know about for so long. So I think that expectation management is such a key part of investing, and really knowing that as you get into these investments, look, there's risk in any type of investing that you do. Look at bonds. Look at the banks, right? SVB that just failed and everything, with, investing in bonds, right? Which was supposed to be one of the safest things. We've had 2 occasions where, my wife, and I wrote this about this in my book, my wife was generously gifted a portion of Kodak stock by her dad to her. And, a blue chip company that would be recommended by every financial advisor, right, across the country, across all firms, they go bankrupt, and there's no recourse, there's no nothing, right? And what's Warren Buffett's number 1 rule? Don't lose money, right? But I think, you have to realize that in this, game of investing, not everything is going to be a home run. Right. And I think, managing your expectations that, sometimes there's some things outside of your control you can't kind of manage to, and that will actually make you, a better investor. And as you kind of allocate capital and build your portfolio.
Diversification, those are all great points, is to me the only approach to use, to your point. There could be a bad actor out there. There could be a fraud case out there. There could be an economic thing. There could be a natural disaster in a particular market. There could be a GP that fails to do their job. These are all risk points, right? So this is why, number 1, I recommend that people invest in what they know and understand the best, primarily. Right. So the more you know, the less risk you take on a particular asset type, but that you also pay attention to branching out a little bit. So over the years, for no other reason than learning other asset classes and having a step to pivot to if I need to, I've gotten more into car washes and ATM machines and self-storage and mobile home parks and, covered calls with my brokerage account and ETFs that do it for me and different things. Right. So that if my primary asset class stops making sense, let's say a multifamily deal in 10 years says, hey, we'll pay you 1% cash flow and 2% upside. No, I'm just not going to do it. So I need to know what else I can do to get a healthier yield and not be a one-trick pony, so to speak. But those are all great points.
Yeah, no, totally agree with that. What do you think is the biggest risk in investing in multifamily right now?
It's going to come down to debt structure and operator. So it's the ability that the operator can actually execute the business plan that they're proposing to you. Okay. So that's usually like, if I look at a multifamily syndication, I'm looking at really 3 macro level things. I'm looking at the operator, the market, and the deal. They're all really important, but I put about a 50% emphasis on the operator. And that's based off my own experiences of seeing a newer operator that couldn't execute and what happened to our overall returns, and getting into like a so-so deal, but the market was just crushing it and we all did well, what impact that's had in my single family days, things like that. And then the common sense of just doing a good deal, that makes logical sense, that cash flows day one and stuff like that. The debt structure, a lot of people now, of course, are moving to fixed rate debt on a longer term than doing these, 1 to 2 year floating rate deals, But what was interesting about 2021 and 2020 is if you really looked at the forward projected curve on interest rates and you really tuned into quote unquote some of the smartest people that are out there, none of them predicted what happened. I mean, and when I say none, I'm sure there was someone that's, taking claim to fame there, but the majority were saying, yeah, they might ease up a little bit, but it's not going to be crazy. And then all of a sudden we take them up to what, 5.25 Fed funds rate. So a lot of people were caught off guard with that. And that adjustable rate debt had made logical sense in all the years prior. And it had been working and working and working, just like the bond example with SPV. It had been working, but all of a sudden things quit working because you're going to have a cycle reset. So something to be mindful of, and to, again, just diversify if you can.
Yeah, totally agree. So if you could design the perfect investment, what do you think it would look like?
Ooh, it would be a real estate deal, because I always like to think of things like, is what I'm investing in really needed? Is it really necessary? Right. And this is the problem I have with so many stocks that are in the stock market. Do you really need Coca-Cola? I don't know. Do you really need McDonald's? I mean, the truth is we just don't. But do we really need affordable places for people to live? Has that really been around for a long time and been working and have a long track record of success? It has. And I'll tell you a quick story. 2 weeks ago, we were out in Colorado. I was visiting some family. I grew up in Fort Collins, Colorado, and we were downtown Fort Collins. And I hadn't been there in years and years and years, but I'm looking around at all the retail shops that I remember as a kid. And I would say at least 50% have changed hands. They've gone under for one reason or another. And we walk by the store, and on the window, it says, "We've been here in this location for 90 years in Fort Collins." And that happened to be a flower shop. So, it's worth considering, are people always going to want flowers for one reason or another, whether, wedding, funeral, Valentine's Day? The answer is yes. That usually works. The same with like a liquor store, generally speaking, if we exclude the prohibition days, but, those typically work in up markets, down markets, and sideways markets. So to go into an investment of like, I have this new trendy idea no one's ever thought of. It's a little hipster bar, and we're going to have little sparklers in the martinis and neon lights. I'm not going to invest in something like that, because that's a fad and a trend and doesn't have a proven track record of success. So back to your question, it's a real estate deal. It's got a hefty amount of cash flow to it. It's got fairly low leverage, maybe 60% leverage. It's got fixed rate debt on it. It's got great equity upside. We're buying it off market at a discount, and it's going to have some lucrative tax advantages that are in the tax code currently. And I just personally don't think it gets better than that for me and what I'm trying to accomplish.
Yeah. No, well said, Travis. And I think really, understanding the, macroeconomics and fundamentals of an asset class is really where you should start. Right. Yes. We've had countless people talk about, people always like to talk about, okay, what was your worst investment? Right. And why did that go wrong? And in a lot of cases, people really just point out they invested in something they didn't know enough about. Yep. Right. So you've got to be kind of smart on that. But when you can start from that kind of macro view and realize we have a housing shortage in the country of, what is it, 6 million units, currently, something like that, yep. Right? You've got some supply demand imbalances. And then, we talked about earlier, markets like, Florida, Texas, Arizona, right? Some of these hot markets where people are just leaving, the North and tier 1 cities because they want to pay lower taxes. They want a better lifestyle. So a lot of things kind of driving that. So appreciate that point. Travis, if you could give just one piece of advice or your biggest insight that you could share with the audience in terms of how they could accelerate their own wealth journey, what would it be?
Oh boy, that's a tough one. A mentor of mine years and years ago said, double down on what's working. And I guess I would just happen to be at a time in my life where really nothing was working except real estate. So I shut down all these little small businesses I had, and I went full force into it. But again, I had to do a little reflection on what we just discussed. Is it necessary? Does it have a track record of success? Like, you want to try to put the odds in your favor. Pretend like you're the casino in Vegas and not the consumer, right? So the odds have to be in your favor. So I like to look at any investment with maybe 3 outcomes and 2 being in my favor and 1 not being. But the fact is, when people go try experimental businesses, the majority of those fail. So you're starting from the opposite perspective of everything stacked against me. I hope this works. And I would just say to that person, why?
Yeah. Yeah, no, I mean, really sage advice there, right? Because, and I think there's a lot of misnomers, and people just need to get smarter out there and just look, Wall Street is really, such a culprit. And this is why I get really passionate about this topic too, because there's certain things, right, that they talk to you about, which is, that accumulation theory, right? And save and save and save and defer your taxes along the way, by the way, right? Well, the only thing I'm certain of is taxes are going to go up in the future. So wouldn't you rather pay the taxes now versus at the harvest time?
Well, you look at like a traditional IRA, which a lot of people have been sold, or a traditional 401k, and you're like, so you're going to make investments that otherwise would be treated in a favorable tax way, right? Long-term capital gains, things like that, real estate having all these tax advantages, and you're going to put it in an account where you're going to get taxed at ordinary income levels. So again, why? It's like if you just did it in cash, you might pay 15% on your tax for example purposes, but now you might pay 30 or 40% tax because it's in an IRA. And the whole name of the game, I worked for a very large brokerage firm, one of the biggest in the world for a short period of time, is assets under management, man. Here's the business model. And if this doesn't make sense from a business perspective, I think you're crazy. But here, give me your money. Let me take a 2% fee no matter what happens to your investment or your money, and just give me all of it for the rest of your life. How about that? That's the business model.
Exactly. Yeah. Well, and another one that's even better. Think about the government.
Yeah. Right.
We want you to put all your money in 401ks, IRAs, all of these different vehicles. And then when you turn 65, I know exactly how much revenue you're going to pay me. And if I'm short on revenue, I can actually tell you, you need to pay me more. Yeah. And then I can even tell you every year you have these RMDs, which is how much, you have to take out so you can pay me. So talk about the ultimate passive income scheme, right? It's a beautiful business plan, like you say, on the other side of the fence for the government and for Wall Street.
Yeah. Yeah. And, there's always, not to bash these accounts entirely, like there's reasons you might have them. There's opportunities. Let's say your employer matches dollar for dollar on your 401k. Like there could be a reason to do that stuff. You put in 1,000, your employer puts in 1,000, whatever. But as far as like going hard and heavy and maxing it out to its, max potential and putting all your eggs in that basket, to me, if you read the book 401 Chaos by Andy Tanner, it'll vastly change your perspective. Let's just put it that way.
Yeah. Awesome. Travis, such a great conversation. I know the audience is really going to enjoy this one. If people would like to, connect with you and learn more about, what you're up to, what is the best place?
Yeah. So whatever your preferred platform is, I'm on Instagram and Facebook at Passive Investor Tips, and I'm on Bigger Pockets and LinkedIn and other platforms, Travis Watts. And I have a landing page. It's ashcroftcapital.com/Travis. And I've got my calendar on there, and we can talk about whatever you want to talk about. You don't need to be an accredited investor. It doesn't have to be a conversation about Ashcroft Capital. Just that's where I put my calendar publicly. So I encourage you to reach out with any questions that you didn't fully understand, that I didn't do a good job articulating, or anything you want to learn from here, and be happy to help.
Awesome. Really appreciate the discussion, Travis, and we'll see you the next time.
Thanks, Dave. Thanks, everybody.